And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we kick off the middle of April and getting ready to already starting to move into summer months here as we get through this month. May right around the corner, of course, end of school, summer starts. So again, moving fast through the year already. It's hard to believe. Right in the midst now, as of Friday, kicking off earnings season with JP Morgan and Bank of America kicking off earnings again. That helped, give some a little bit of relief, right, to this whole banking crisis sector thing. At least their initial earnings on JP Morgan's side is a good example. Were very, very good with a 49% increase in net interest income. Not surprising when they get 4.5% from the Fed and they give you nothing on money market rates. It tends to work out really well for their balance sheet. But again, that gave a little bit of relief to the financial sector. Markets sold off anyway on Friday, primarily due to much weaker than expected retail sales. Now, as we've been talking about for a while, the retail consumer continues to remain under pressure. Not surprising now because of higher inflation and those type of things. We're starting to see that weakness show up in the retail sales side of the ledger. But again, what we're going to need to see here, though, is a continuation of that. It's been very interesting to kind of watch what's been going on, within the economy. It's just been kind of one hit after another, but the market's been fairly resilient here, and really over the last few weeks here, we've had a very nice rally in the market, coming off of those lows that we had set back in February and March, following the whole Silicon Valley Bank crisis, etc. Those concerns have been somewhat alleviated, of course, as the Federal Reserve has stepped in, the Treasury has stepped in, assuring depositors that they won't, lose money, they'll be fine. And again, we haven't seen any more real, kind of issues with banks over the last few weeks. Now, again, this week, importantly, we are going to be seeing results from a lot of regional banks. Now, we're going to start stepping down the scale here a little bit from the majors, of course, of JP Morgan, et cetera. Now, moving down into these smaller and, I would say mid-sized to smaller banks this week. And so this is going to be really the first look. Money was flowing out of banks, the smaller banks, into the big banks like JP Morgan. So again, they're not really the concern. We're not going to have another banking crisis of a Lehman Brothers type moment like we saw back in 2008. But we could have more banking issues with banks in that smaller kind of regional area, kind of more reminiscent of the savings and loan crisis back in the 80s. So again, we could see some more of that. We're going to see that in earnings as we start to see these banks report. Of course, Friday did kick off the actual official earnings season for quarter one. So now we're going to be looking at all these quarter one earnings reports coming in over the next couple of weeks. May the 5th, so just a couple of weeks from now, when we get to May the 5th, we will have about 88% of the S&P 500 reporting. So we're going to have a really good take by the end of this month about just how robust earnings are, and really what's going to be key here, and we've said this before, is what do the CEOs say about the economy and the markets and their outlook? Are things getting better? Are they still worried? CEO confidence as of the end of last quarter, that comes out quarterly. We'll be getting an update from Matt here soon. But CEO confidence as of the end of the year was at some of the lowest levels on record. Again, their outlook not great. Did that improve in the first quarter? That's what we want to see from these earnings reports. So again, this morning, futures are slightly positive. The Dow's up about 25, 26 points. S&P's up about 6 right now. So again, there's not a lot of overall concern in the markets at this point. And again, this has been kind of frustrating, again, for a lot of people that, have a much more bearish view on the economy. Is like, oh my gosh, we're going to have, a big recession and those type of things. Yet it really hasn't materialized yet, at least not in the markets. Again, we did have a bit of a correction last year in the markets, not surprising. Because we had such a big run up going back to, 2020, 2021. We just had this very, very big advance in the markets following the pandemic shutdown. So yeah, it wasn't surprising to see the markets pull back here a bit. And so we did have this kind of corrective phase, but the market's been doing a nice job here since October of bottoming, holding those bottoms, and again, just kind of trending here higher. It's been sloppy, but the market's just been kind of trending higher here, not really doing anything wrong, and just really consolidating this really outsized advance that the markets had back in 2020, 2021 because of all of that stimulus. So again, that stimulus came into the system, created the supply-demand imbalance that led to a big surge in earnings. Expectations are now, of course, is that what are we going to do next, right? This is going to be the big question. Markets right now expecting the Fed to start cutting rates as soon as June. But again, as we've said before, without really a recession or some type of event, financial crisis, etc., not really much of a reason for the Fed to cut rates. So markets kind of, holding up well, rallying well here over the last several weeks. But again, not really doing anything of importance really in one direction or the other. Markets are getting a bit overbought here short term. So again, a little bit of sloppiness here won't be surprising. And so as we get into earnings here over the next couple of weeks, again, that's really what's going to be driving markets. So don't be surprised here if we get a little bit more market volatility as we start getting, I would suspect what will be more hit and miss earnings. I think some companies will do well. Tech companies probably did okay in the last quarter. Other companies that are more consumer-oriented, consumer-based companies probably didn't do as well because of just slowing economic spending by customers. We're seeing that slow down again as the retail sales showed for the month of March. We're starting to see that hit to the actual individuals. But again, other companies that are more business to business may be doing okay. So again, it could be a very spotty earnings season. So a bit of volatility pickup here won't be surprising at all. So just be aware of that because market's still on a buy signal right now. Again, nothing inherently wrong with the markets. Again, lots of negative media headlines. Markets tend to climb a wall of worry, and that's kind of what has been happening here as of late. So again, some things we'll just have to keep a watch on. No real clear indication of where the markets are going right now. But one thing I want to talk about coming back after the break, I was doing Fox Business on Friday with Charles Payne, and just before me was Ann Sonders from Charles Schwab, and she made a very interesting comment that had me thinking all weekend about the idea of a recession and what's been going on in the economy and what the impact to the markets is and why markets have actually been holding up a whole lot better. And in spite of all this, big news, right? Whether it's SPACs or IPOs or commercial residential real estate. Now everybody's a commercial real estate expert. So just over the weekend, just news article after podcast about the coming commercial real estate crisis. That's been known for a while. And now everybody's focused on it because, well, the banking crisis is now behind us and the IPO SPAC crash is behind us. And again, she made this very interesting comment that may explain somewhat about why the markets are being so resilient right now, despite the fact of what's going on with higher rates, less monetary accommodation, et cetera. So all that's coming up. Be sure to get by our website, of course. Our newsletter is out this weekend talking about as inflation is easing, the big question right now is the Fed next. Will they start easing next on the path of inflation? That's on the website now. Of course, we also touch on earnings as well since we're starting earnings season. That's on the website, realinvestmentadvice.com. Of course, we'll be right back after the break.
Investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, welcome back to the show this morning, by the way. So, like I said, on Friday, I was doing an interview with Charles Payne on Fox Business, and Ann Sonders was on just before me, so I could hear her, in my headset while she was talking, and she made a very interesting comment about why the market has been holding up so well relative to what's going on kind of overall, really, since last year. And, you think about what we've been through, right? We had an 80% drag on speculative, non-profitable tech, right? Huge decline in some of those stocks, the Rokus of the world, et cetera. A lot of those stocks were down 70, 80, 90% from their peaks in the first couple of quarters of 2023. 2022. Forgot what year I'm in. Of course, they had a huge run-up in 2021 and 2020 because of all the speculative frenzy that was going on in the markets, because you injected $5 trillion of liquidity, of course, into the bank accounts of individuals, and so they went and speculated in the financial markets. So that's all fine, and good. And then we had, following that, then you had kind of the used car debacle. Right? So a lot of used car prices came down. And then you had, kind of the onset of the real estate decline. Real estate prices started coming down around the country. Now, this is latter in the year, so latter part of last year. And then early this year, you then have a banking crisis, right? Silicon Valley Bank, et cetera. Fed's hiking rates, which historically isn't great for markets. But yet the markets have really held up very well overall. And if you take a look at, where we are, yes, the markets were down about 20% last year, but my gosh, you had a huge advance in 2020, 2021. And yeah, so you gave up about a third of that advance, which that would be in a normal market environment. If we were in just kind of a normal environment, right? X 2020, 2021, prior to that, if you had a year where the market was up, 10, 12%, and then the market was down, 4 or 5% the next year, it's like no big deal, right? It's a correction. Because the market was down 20% last year, everybody's like, oh my gosh, it's a bear market. Well, not really. You have to put it in context that you were up so much in 2020, 2021. You've just had a correction, really, of a little bit of that advance. Most of that advance is still encapsulated in the financial markets. And this is one of the reasons why the Fed hasn't been panicking as of late, because again, when they look at the markets, they look at it in a longer term time frame and they say, well, the wealth effect is still clearly there, right? We haven't given up, all the advances that we made in 2020, 2021. And now markets are rallying again. And so the point she made is everybody keeps asking the question, right? In the mainstream media, every time I do, mainstream media, the only question is either inflation or recession. That's the two big questions, right? Going to have a recession. It's obvious, it's apparent we're having a recession. And doesn't that mean stocks have to decline a lot more? And historically, that would be the case. Yes, if you said, look, a recession's coming, and during recession, stocks lose on average about 33%. That's history. That's what it tells us. Now, we're already down 20%. We haven't gotten to the recession yet, theoretically, right? At least the National Bureau of Economic Research has not dated the recession. And so if we assume that the National Bureau of Economic Research will date the recession, let's just say that they date the recession starting on January the 1st of 2023. Let's just assume that for a moment. Markets were down 20% last year. So the markets declined in advance of the declaration of a recession. So if markets decline on average 33% during a recession, then, well, we've already got 20% of that 33% out of the way. So that limits some of the downside risk. But the point that Ann made, which I thought was important, is that while we've not had a declaration of a recession, we've been kind of going through this rolling recession. We took a hit in non-profitable tech. Then we took a hit in real estate. Then we took a hit in banking. And markets are, and this is giving the markets time to adjust for these factors. And again, normally what happens in a lot of cases is that things kind of hit all at once, right? And this is what everybody's been expecting, is everybody's waiting for this recession to where the bottom falls out of the market. And all of a sudden, it's a recognition. It's like, well, we have this big economic decline and stock prices are falling and earnings are collapsing, et cetera. Yeah, I'm not saying that still can't happen, right? But one of the interesting, and it's an interesting premise to think about, well, earnings have taken a hit a little bit, not a lot, but they have taken a hit. And we've had these events that have happened and they've been kind of scattered out, which is allowing the markets to kind of absorb the hits. So if you kind of think about, rather than get hit, getting a Mike Tyson knockdown punch, right? If you're old enough to remember Mike Tyson. You're getting hit by these lighter kind of punches. And so the market's able to absorb these hits and recover from them before the next hit impacts it. And so that's slowing the momentum of the markets, which we've clearly had, right? You compare the rise in the markets in 2020, 2021, and we clearly don't have that kind of, accelerated exuberance in the markets right now. Lots of bearishness, actually. And so the market's able to absorb these hits without collapsing. And this is frustrating. If you're looking for the bearish fallout, like I am, super short the markets and I'm just waiting for the shoe to drop here and I'm going to make a bunch of money. It might not happen. And that's what I'm saying, is that Ann Sonders has a very interesting point here. And, I think we have to consider that because, again, if the market's able to absorb these hits, then that limits the downside risk to the markets. Now, doesn't mean there's a tremendous amount of upside either. And that's the other side of the coin. So let's assume this. And this is the problem that we face in the markets right now in terms of managing money and investing and these type of things. So right now, we're entering earnings season, and so far we've had a couple of banks report, and those earnings were good. And stocks rallied, and that kind of gave some relief to the markets. But then these are the big major banks. We haven't heard from the smaller banks. This week, we'll hear from M&T Bank. We'll also hear from State Street, Charles Schwab, and I'm not really that concerned about Charles Schwab. They're on the big side, and most of their money is on the investment banking. The investing side of the business. So Schwab's not really, even though they do have a bank. There is a Schwab bank. Don't get me wrong. They're not a traditional bank as we think about it. So M&T Bank, PNC, and some of these small regional banks, when they start to report, that's going to be a much better tell about where we are actually within this whole banking situation. Is it was at Silicon Valley Bank and First Republic, were they just one-off events, or were they a much more kind of canary in the coal mine for a bigger kind of banking recession? We'll see. But we'll get those reports this week. But again, as we kind of just think about these things, again, this makes it challenging because now what the market's expecting is that earnings are going to start to recover after this quarter. So things are going to get better from here. This is expectations from Wall Street analysts. By end of 2024, earnings will be back to where they were at the peak of the market in 2022. So again, that implies a no recession scenario with fairly strong economic growth to generate that kind of earnings growth. Market's also expecting the Fed to start cutting rates and inflation to come down. So if inflation is falling, that means that pricing power for earnings will also weaken. So earnings won't be able to grow as fast, which could disappoint markets because earnings aren't growing as fast as markets currently expect. And that could put a cap on prices. So one of the considerations here is that, again, let's go back to Liz Ann's view, is that, yes, we could be having this rolling recession that limits the downside risk of the market. So maybe there's not another big down leg to equity prices coming. Maybe most of that sell-off has occurred. Maybe not. But maybe this is the consideration. But the other side of this is there's really not a lot of catalyst for a massive amount of upside either. Weaker economic growth, falling inflation is not supportive of rapidly growing earnings to support current valuations, which are still elevated. So again, looking at a market environment, we could be in a more disappointing environment from the standpoint that, well, we just really don't go anywhere. We just kind of continue to have these intermittent rallies followed by these intermittent sell-offs. And we just wind up really not making a lot of progress overall. That's going to be the challenge this year. Until we get through all of this, right? Then we'll be able to look back and say, oh yeah, well, there's, the great thing about hindsight is that we'll know exactly what the answer was. All right, be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'll put like $100 bill in my wallet just because, again, you break down on the side of the road, something like that. I'm old, right? So I'm a boomer. I just feel like I have more security if I have a little bit of cash in my wallet just in case.
The Real Investment Show podcast.
But as soon as I have cash in my wallet, my kids invariably ask me for money. I don't know how they know I have cash in my wallet, but they have a direct link mentally to my wallet.
At realinvestmentadvice.com.
My kids are psychic.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So let's, we were just talking a little bit about this idea of kind of this rolling recession. It's kind of just been one little hit after another to the economy, and not all at once, which has enabled the markets to hold up better than you would have expected because these hits are kind of getting spaced out enough time to give markets to absorb them. And this is a very important fact about the markets, by the way. Remember that markets are a live organism, right? It's buyers and sellers. And the one thing we tend to forget is we tend to think about the markets as this thing, right? This unintelligent thing that's just there. And it's like, how can the markets be missing this banking crisis? Well, they're not. But we're talking so much about these things, right? You know, last year, everybody was talking about a recession. And so the markets start adopting this idea of a recession and pricing accordingly. And this is what we mean by when the market prices things in. When everybody's talking about something, or if everybody's taking a specific action, the market reflects that. Because the market is a reflection of this organism of buyers and sellers that are out there. So again, while the market may not do what we think it should do, doesn't mean that it's not accommodating these views in one fashion, form, or another. So this is the important thing to always remember. And so this is, why we kind of get a little confounded with, I don't understand why the market's, not doing this or not doing that because of A, B, or C. As well, it is factoring these things in. It's just doing it so in a manner that is not necessarily as bearish as you think it should be. And again, what you think and what the market thinks can be two entirely different things. This is why it's important to kind of remain outside that view and just pay attention to what the markets are doing rather than what you think it should do. But again, this idea of this rolling recession is something to consider, because it's allowing the market time to absorb these impacts. Let's talk about retail sales for a second, because I thought there was a lot of interesting aspects from the retail sales report that came in on Friday. So on Friday, retail sales dropped by 1%. Now, once we get real retail sales out, that'll be a much deeper decline, obviously, because of inflation. But obviously, retail sales missed expectations by a wide margin. This is really the first big hit to retail sales that we've seen during this whole cycle, right? Retail consumers have been much more resilient on spending up to this point. This is the first real kind of hit. But we've talked about this for a long time now that all of that money that we gave to individuals had been in the system, right? So initially they had cash to spend, and then they had, and some of them paid off credit cards. So credit card debt levels dropped, which gave them room to start when they ran out of cash. The reduced levels of credit card debt gave them room to start ramping up credit again, and banks were still, providing more credit through credit cards. Now, banks are pulling that back now. They're not giving people access to as much credit or as easy credit as they were before. And here's what's important. If you take a look at that retail sales report, kind of buried inside of it, sales at general merchandise stores were under pressure. This is according to Yahoo Finance. Department store sales were under pressure. Taken together, the retail sales report shouted loudly, the consumer is under increasing stress. And again, that's absolutely correct. Importantly, appliance sales were down. Now, again, this isn't surprising. None of this is surprising, right? General merchandise stores, department stores, appliance sales, all those were down. The reason it's not surprising is again, let's go back to 2020, 2021. I send you checks. Your stove is fine. It's just old. Right? Your wife's been asking you, she wants, a new gas stove or whatever it is, new microwave, whatever it is you want for your kitchen, or you want a new deck in the backyard, or new furniture, right? Your couch is fine, but it's out of date, so you want a new couch. Whatever it was around your house, new wardrobe. All of a sudden, you had this extra money that you didn't have before, and so you go, hey, let's go buy this stuff, right? Government just gave us free money. Let's go buy that couch. Let's go buy a new stove. Let's go buy a new dishwasher, refrigerator, washer and dryer. Let's build a home office and buy new computers. All those things were going on in the economy in 2020, 2021. But here's what nobody paid attention to was the fact that, well, if I just bought a new stove a year or so ago, I don't need to buy a new stove now. And this is the problem with what we call pull forward consumption. This is when I give you money and you go buy stuff today that otherwise you wouldn't have bought. So, think about it through used cars as a good example. Your car is fine. But I give you enough money as like, yeah, my car's a little old. It doesn't have GPS, right? Whatever. So you go, well, I was going to buy a car in a couple more years, but now that I have this money, I'll just go buy it now. So now you've pulled forward that purchase that would have been 2 years from now. You pulled it forward to this year, but now you're not going to buy a new car in 2 years. So those purchases for washers, dryers, refrigerators, decks, whatever it was, lawnmowers, all that stuff that people would have bought this year and next year and the year after was bought in 2020, 2021. So now I don't need to buy that stuff. So that void is now getting pulled forward. And as people are running out of cash and they're running out of, credit and those type of things, and this is particularly on those in the bottom 80% of the income earners, as those pockets of cushion evaporate, retail sales will slow down. Now, again, doesn't mean we're going to have a big retail sales crash. That's not what I'm saying. It's just going to slow down, which is going to do what? This is the whole point about inflation. And I've got a report coming out tomorrow on break-even inflation rates. On Friday, on break-even inflation rates. But this is the important thing about inflation is that in 2020, 2021, inflation gave pricing power to corporations who were able to say, yeah, I don't have a lot of lawnmowers to sell you because I can't replace them, right? Nobody's making them right now because everything's shut down. So I'm going to charge you more for that lawnmower if you want it. and people were willing to pay a higher price because they wanted it now, because they didn't have any patience. And of course, this is where people, start pointing fingers at corporations. So like, greedflation. No, that's basic economics, supply and demand. That's how capitalism works. You may not like it, but that's the way it works. So now, of course, as inflation, so that gave corporations big pricing power, right? Because all of a sudden, I have a limited supply, I can charge more for it. You've got money to spend on it because the government just gave you money. So yeah, my profit margins are going to swell a lot. And they did, because at the same time that they were able to charge you more for a good or service, they also were laying off all their employees because the economy was shut down, which was really boosting their profit margins. Well, now employment's back. And as inflation is coming down, that means corporations have less pricing power. So earnings will come under pressure. The markets are going to have to adopt for this. But let's continue on with what's going on in this earnings report. Buried inside the earnings report, moderate paces of growth in debit and credit card spending, resulting in big ticket categories such as autos and housing, were soft. This is also at the at JP Morgan and Wells Fargo as well. Right? Even the big banks are getting hit by this. Poor results from CarMax also pointed to that, as auto sales are clearly slowing down now. If you take a look at what's going on with Macy's, Dollar General, Abercrombie and Fitch, they've all underperformed the S&P, along with Nike, over the last 3 months. As the obvious weakness in retail sales is becoming more apparent. And this is likely going to be a bit more time that we have to work through this. But this is just a function of a slowing economic environment, which, by the way, that's what the Fed wants. The Fed wants to slow the economy by hiking interest rates, and you do that by increasing borrowing costs. And to get inflation to come down, I've got to slow demand. Again, what is inflation? Inflation isn't this magical, mythical thing that just shows up. It's a very basic premise of economic supply and demand. That is it. I give you money. I shut down the economy. I have demand and no supply. I have inflation. That's it. The inflation wasn't money printing. The inflation wasn't anything else. It is a basic function of supply and demand. That's why you have inflation. Inflation will go away naturally as all that money that was in the system, right? Those checks to households that we send, as that gets used and floats through the system, and as M2 is a function of GDP falls, so too will inflation. In other words, as demand begins to underperform supply, and this is an interesting point about supply that we'll talk about right after the break, is the reversal of 3 decades of just-in-time inventory management to just-in-case inventory management. And another big drag on inflation. Talk about that after the break. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So back in the 70s and in the 80s, early 80s, right? We were starting to come to recognize this thing that Japan was doing at the time called just-in-time inventory management, and it was slowly getting adopted in the U.S. And just-in-time inventory management was a revolutionary idea about inventory management, because before that, what companies would do is they would you sell a widget, right? So companies would say, okay, I think I've got I'm going to sell 1 million widgets this year, so they go stock 1 million widgets in inventory and they sell it off as orders come in, right? So they're spending all this money on inventory, stocking it up in warehouses. And then as orders come in, they fill the orders, right? And so that was inventory management system. Well, Japan was doing this very different idea, and they developed this idea called just-in-time inventory management, which was to stock just enough inventory to meet the orders coming in. And then as those orders are coming in, you're buying some new inventory to catch the next orders, right? And this kept the cost of managing and maintaining inventories, and especially if you had inventory that was perishable or could be destroyed due to, rust or exposure to, the elements, whatever it was. This lowered a lot of costs and made the businesses much more profitable. And of course, we began to adopt this in the United States, particularly as we started coming along with things like that stupid program that nobody thought would ever work called FedEx. Who the hell needs stuff overnight, right? That's just ridiculous. But as we became more efficient through fax machines and then FedEx, the internet, faster shipping times, all these type of things, then inventory management all shifted towards just in time, keeping just enough inventory on hand to meet shipments. And I could get new inventory fairly quickly, so I didn't need to really keep a lot of inventory on hand. This made companies a lot more profitable. Well, that all worked fine and dandy. We talked about this back in early 2020 when we shut down the economy. You said, this is where just-in-time management's about to bite you in the butt. Because all of a sudden, you couldn't get inventory. Just-in-time management's fine as long as supply chain is working. Because I can get the supplies I need, right? That's the whole point of just-in-time management, is I keep just enough on hand to meet demand, and I can go get more stuff, and that's fine. That all works until you shut down the economy and you can't get it. And then that's where just-in-time inventory management becomes a problem, and that's what happened. Now, here's an interesting byproduct of this is going on now is that we've gone from just-in-time inventory management to just-in-case inventory management, which is where companies are now holding more inventory because what happens if, right? Just in case we have another shutdown, I'm going to hold some more inventory on hand. And so this has implications, right? Because now the cost of inventories will weigh on profitability as well. Now, they're not holding a year's worth of supply, but we're definitely seeing increases in the amount of inventory sitting on the books of businesses because just in case. And this kind of goes back to our earlier conversation about why markets, there may not be a lot of downside in markets, but there also may not be a lot of upside in markets either. And as inflation comes down, that's going to weigh on pricing pressures for businesses. And furthermore, if, and again, back to pricing and these type of things, one of the other potential drags on inflation is going to be the fact that at some point, these companies that are holding these excess inventories, they're going to come back to the realizations that, okay, the supply chain is fine. It's not going to get shut down again. So now I need to get rid of this excess inventory, and the only way I do that is how? Cut prices, which is more deflationary pressures. So this is part of this that we're going to kind of be watching over the course of the next, several months. But the main takeaway as we head into this week, of course, is earnings, and watch this economic data. Today, we're going to be looking at Empire Fed manufacturing indexes, the National Association of Home Builders Index as well. Are they starting to see a bottom, potentially in the housing market? They've been much more optimistic than what is going on in the housing market in particular. But we'll see if that, keep a watch on that. One of the things that we are seeing right now is we're seeing an uptick in home inventory. Home purchase activity because of the very small drop in mortgage rates. A lot of people, kind of like the market, they don't want to miss the bottom. So every time markets drop a little bit, investors are running in to buy up stocks on that kind of the FOMO. It's what we call reverse FOMO, right? In 2020, 2021, markets are going up and investors were buying on the fear of missing out on the rally. Now it's this fear of missing out on the bottom. FOMOB. So every time market dips a little bit, investors are showing up to buy the dip. And that's really been the case all last year, and it's been the case this year. Kind of the same thing in housing. Every time there's even just a modest pullback in mortgages, people are running out and trying to buy a house because they're afraid they're going to miss out on the decline. Even though it's only been a small decline in housing prices on a national basis. Now, there's certain areas of the country that have seen 20 and 30% declines in home prices, but those were also the areas that had the biggest run-ups in home prices in 2020, 2021. California, those type of areas. Other parts of the country have not seen that big of a price decline, but people are unwilling to try to miss out on this. And so it's a psychology thing with people. But this week, like I said, we've got a lot going on. We're going to really get into earnings big time this week. Netflix is this week. We've got, like I said, a lot of banks today. We've got Pinnacle, M&T, J.B. Hunt on the transportation side. Tesla is on Wednesday. Procter & Gamble is on Friday. American Express is Thursday. AT&T. So this week's a lot of earnings. So earnings will be moving the markets for the most part. And again, the thing to really be paying attention to is not the earnings themselves. Again, these earnings have already been dropped a lot since last year. And I was putting that in the newsletter this past weekend, is that we were talking about earnings on, I think, Thursday, that earnings had declined from $220-some a share to $172 a share. Well, just in the last 2 weeks, That's numbers already dropped again to 171 and change. So just in the last 2 weeks, S&P has cut estimates for this quarter earnings even more. So we keep lowering that bar. So again, don't really pay too much attention to what they announce, because most likely they're going to beat these estimates because they've been lowered so much. But it's going to be more important to pay attention to what they say about future quarters. Are they getting more optimistic? Are things improving in their view? That will be what is moving markets more than anything else. So again, the important takeaway from this, is over the weekend, just everything I was looking at over the weekend, very bearish. A lot of podcasts out right now, the end of the world, dollars and this, headline after headline, very bearish. So it's easy to get on that bearish side, easy to get over there, right? I'm right there with you. But we also have to remember, as I said, this whole morning, is pay attention to what the market's doing versus what you're reading, because those don't necessarily have to align with each other. And again, this idea of a rolling recession, I think, has some merit to it. Now, it doesn't mean there's not some downside left in the markets. I'm not saying that at all. But there is some merit to this idea that this rolling recession has allowed the market to absorb some of these punches and allows it to hold up better than what you might expect because of all the stuff that's going on, right? Do we have a recession coming? Probably. Could it be a really deep recession? Sure, it could be. But it could also be a much milder recession than we expect because of the ability of both the economy over the last year, because of all this M2 that's been in the system, M2 as a percentage of GDP, has allowed the economy to slow down without crashing. We'll see. I have no idea. I'm not saying one view is right or the other view is right. I'm not making a declaration of everybody's wrong and I'm right. I'm not saying that at all. I'm saying what we have to do as investors is consider possibilities. This has been the argument that we've been making now for the last 8 months. It's just consider the possibilities that whatever view you have, bullish or bearish, could be wrong. Just consider the possibility. And then review your portfolio, your allocation, and say, okay, how am I allocated? And what if I'm wrong? Do I have any type of protection put into place against being wrong one way or the other? What if the market keeps running? And again, this is the one thing about, let me give bears some kudos here for just a second. While being bearish is always considered to be bad, the one good thing about being bearish is that you're really kind of hedged against losing money. You may not make money, but you're probably not going to lose a lot of money. Bulls, on the other hand, can make a lot of money, but if they're wrong, they can lose a lot of money. So one thing about being a little bit bearish in your portfolio right now is that, considering we don't know where things are going, at least it limits the ability for you to have losses. Just one thing to take away. Anyway, wraps up the show for today. Get by the website. Our latest newsletter is out. It's on the website now, realinvestmentadvice.com. I'll have our blog post out tomorrow, as always. And of course, we'll be back in the morning. We'll talk about what goes on with these earnings today with Schwab, Pinnacle, M&T, others. We'll talk about what those first initial blushes look like and how the market responded. We'll do that in the morning. In the meantime, have a great day. We'll see you back then.